Hi there, ACCA students. How are you? I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Mutimkulu Jerry. In this particular video, we are going to go through some little quiz. Yes, a few questions, about 10 or 12 questions, which we found to be very, very useful for you to understand the week 5 topic on audit planning and internal controls. All right, so I assume that you guys have read the notes, have listened to the audio, okay, the topic audio, which we sent to you as part of this week's learning. All right, remember we do not have time, so we need to be on our toes as we rush towards the revision phase of this paper. Okay, because we are having the exams just right round, around the corner. So, without much ado, I think it is very, very necessary for us to have a look at this before we start the quizzes. All right, there is what is called the audit risk model. Audit risk model, as you are seeing on the screen. So the audit risk model just gives us an appreciation of what audit risk is all about. Okay, audit risk, in short, is that this is just the risk that the auditor would make an inappropriate audit opinion by the end of his audit work. Okay, he might produce a report with a wrong opinion. That's the risk. All right, but the audit risk is a function. It is a function of the risk of material misstatement and detection risk. Okay? For there to be a wrong opinion, okay, there should be either or both. All right? Either the risk of material misstatement was not managed well, or detection risk wasn't managed well. So what is the risk of material misstatement? This is the risk that the financial statements could be materially misstated. Either there is an omission or a commission that may lead to the financial statements being wrong. And this risk has got two components. The risk of material misstatements has got two components, that is inherent risk as well as control risk. What is inherent risk? Inherent risk is the risk that, due to the nature of the entity or the department or the finance setup, such risk is going to be there. For example, if they have had their finance director resigning during the year, automatically there is an inherent risk that, because of that development, the internal controls, okay, they could be ineffective in terms of the supervision of the accounts department, which might lead to financial statements containing some wrong figures. Or sometimes because of the recent venture or the recent production of certain type of products, there could be some wrong valuation of inventory. Okay, just because of that, the change of focus in the production, it means that now, if they do not use certain experts in preserving the inventory or in valuing the inventory, then the inventory values could be wrong. Okay, that's inherent. But now when we talk of control risk, we are talking of the the effectiveness of the internal controls which are in place. You could also see that when the finance director left the company, that might affect both the inherent and the control risk. Control risk in the sense that there was no longer, effective supervision. Okay, there was no longer effective supervision, which means the controls could be lacking somewhere, somehow. All right. So here on the control risk, we are looking at the effectiveness of the internal controls in timeously detecting and preventing, errors, frauds, and so forth. All right. So that's the risk of material misstatement. But now, the most important point to make here is that the ROM is actually something that could be, that is under the control of the company. Okay, this is the company's problem. Okay, it is not the auditor's problem. But by the end of the day, the auditor has to ensure that even if it is the company's problem, okay, when I say it is the company's problem, I'm just saying it is a risk emanating from the side of the company that is being audited. But the auditor has to worry if there is such development, like, for example, there is now a new line of production, there is something that is recently been introduced, for example, the information system, the IT system, or there's been a major acquisition. All those things, they have emanated from the side of the company that is being audited. All right, they lead to the risk of material misstatement, but the auditor is worried that could make the risk of material misstatement high, and by the end of the day, this will culminate it will culminate into what is called audit risk. So the auditor, during the risk assessment phase, has to see if these risks are not there or are not as high as possible. All right, now let's go to the auditor side. Auditor side. Uh, the auditor side. The auditor side, we have what is called detection risk. This is the risk that the auditor's procedures might not help them to identify the risks, all right, which are underneath. All right. So this is the risk that the auditor's procedures might not identify these items, the risk of material misstatement. All right. Either because of the sampling, sometimes the sample which they used to depend, or which they used in arriving at their opinion was so low, was so small. If you use a small sample, okay, you are likely to get what is called sampling risk, because the items which you picked were not representative of the whole population. So maybe this was because the sample was wrong, or the technique used to sample. Which method were you using? Were you using random sampling? Were you using systematic sampling? Were you using what? You then have to manage well the type of sample. All right, so your sampling should be speaking to the type of business, the type of work you are going to do. Then there is what is called non-sampling risk. Non-sampling risk is the risk that that is not related to sampling. For example, maybe the auditors are few when the company they want to audit is so large, so big. They do not have the resources. They do not have qualified or experienced personnel. All those things. But now, you can't deny the work sometimes, because by the end of the day, the practice needs to pay taxes, needs to pay bills, needs to pay salaries, and so forth. So you just say, you can't just say, oh, because the audit is big, we just have to, deny the work. No, you don't do that. You also have to consider, in as much as you have to worry about that, but you also have to know that you want to survive by the end of the day. You have to pay your ACCA subscriptions, all those things. So before you reject an engagement, you can as well use means like, for example, ensure that you have sent well qualified people during the risk assessment to understand the risks. Okay. Also, you need to devote a lot of time to a particular risk area, and a lot of time and energy and resources, that is well qualified personnel on that particular area and so forth. In so doing, you will be managing the risk, the detection risk. You'll be managing the detection risk, which in the end would reduce the audit risk to an appropriate low level. Okay, that was the background, ladies and gentlemen. Please remember that you cannot enter into the examination without knowing audit risk, the function, which is a function of risk of material misstatement and detection risk. All right, excuse me. All right, so now here are the questions. Let us start with question number 1. According to the audit risk model, if an auditor assesses both inherent risk and control risk as high, what is the necessary course of action to maintain an acceptably low level of overall audit risk? We have just explained this, and this is a very, very resident and common question in this exam. So, according to the audit risk model, if you found that both inherent and control risk are high, what is the necessary course of action to maintain? Which means obviously there's no turning back. The engagement has already been accepted, but you need to then maintain an acceptably low level of overall audit risk. A, the auditor cannot change inherent or control risk, so they must assess them. Why should they assess them? They have done already, because we are told here in the question the assessment has been done. If an auditor assesses both inherent and found that they are high, so why should we then reassess them? So this one automatically is wrong, isn't it? We can't do again another assessment. Remember, there's no time for dilly-dallying. Okay, there are a lot of other engagements to be done. Remember, it is a cost. So you cannot continue reassessing and reassessing. You become problematic even to the client themselves. When they see you, certain guys trying to understand the company and so forth. There's no back and forth. Okay, so A is wrong. B, the auditor can accept a higher detection risk because the other risks are already high. How can you accept a higher detection risk? No, you need to reduce the detection risk. So automatically B is wrong. Okay, see, the auditor must perform significantly more audit work to lower detection risk. Yes, you need to do more work. Both the inherent risk and control risk are high, so you need to devote a lot of manpower, a lot of, to ensure that your detection risk is reduced. Is that clear? That's the response you need to give in that particular situation. Let us see D. So this one is the best answer then. Or let us see D and see if it could be. The auditor must recommend that the client improves its internal controls to lower control risk. Yeah, yes, but this recommendation doesn't have anything to do with the overall audit risk. Okay, in as much as it is to some extent good, because that's what is called a management letter. Okay, or a report to management, an RTM. It is produced as part of this, a byproduct or sub-product to management phase, corporate social responsibility, something like that. Okay, they write some recommendations to management to improve the internal control stuff, but that one would have been done after observing C, after investing much in more audit work, so that the overall audit risk is reduced. Okay, so the answer there is C. Let us proceed. Let's move to part 2. Oh, that was the explanation. Okay, let's look at the explanation to see if we were right. So we are agreeing. I mean, the examiner is agreeing with what we have already said. The answer is the auditor must perform significantly more audit work to lower detection risk. Now, when the risk of material misstatement, inherent and control risk is high, the auditor must compensate by reducing the risk of failing to find a misstatement, which is achieved through more extensive procedures. So we are good to go. Let's move on. Question 2. Which of the following describes control risk in the context of an audit? The susceptibility of an assertion to a misstatement, assuming there are no related controls. This is a definition of what? Actually, A is the definition of what we call inherent risk. So obviously, it is wrong. It is not a description of control risk. When we are talking of the susceptibility, we are only talking of the nature, or let me just say due to the nature, due to the nature, right? Due to the nature of the event, of the control, of the development that have come into effect. All right. So because of that, there is something is going to happen. Okay, is presumed to be, potentially capable of happening. All right. So that one is related to inherent risk. B, the risk that the auditor expresses an inappropriate opinion on the financial statement. This is the definition of audit risk. The ultimate function, isn't it? That's the ultimate, risk we are worried about. Audit risk. That's the risk that the auditor is gonna express an inappropriate opinion on the financial statement. All right, but that's not the answer to the question. See, there is that the auditor's procedures will fail to identify a material misstatement. This is what is called detection risk. And that's not the answer. D, there is that a client's internal control system fails to prevent or correct a material misstatement. And this is the correct answer. That's the control risk we are talking about. It is the risk that the internal control system is not going to be effective. It's not going to be able to prevent or correct a material misstatement when being implemented. So that's our answer. Let us see what the examiner says. The correct answer is D. Okay, so we are good to go. The risk that a client's internal control system fails to prevent or correct a material misstatement. Explanation. Control risk specifically relates to the effectiveness of the client's own systems and procedures in identifying and rectifying errors that have occurred. Why A is wrong? The reason why the examiner is interested in explaining A was saying the susceptibility of an assertion to a misstatement, assuming there are no related controls. And that was a hoodwinger. Yes, or let me just erect an assertion to a misstatement, assuming there are no related controls. This is the definition of inherent risk, which exists due to the nature, like I said, due to the nature of the business or transaction itself, independent of any controls. Thus, this was incorrect. Is that clear? If you are happy, please just give me a thumbs up in the comment section to this video. And if you are new, please don't forget to subscribe, to share, to like, to comment, and make the video viral. Let it be viral. Remember, the ACCA tutor is conducted on WhatsApp 24/7 on +263 774-596-368. This is the number of the ACCA tutor. Anytime, any day. Tell your brothers, your sisters, your friends, your peers that there is an ACCA tutor out there in Zimbabwe. Yeah, Zimbabwean. We're gonna take you abroad. All right, let's move on. Question 3. An auditor uses a computer program to read a client's entire trade receivables file to identify all balances over 90 days old. This is an example of which type of computer assisted audit techniques? CAD. Is this an application control, test data, audit software, or an internal control questionnaire? Sometimes we are talking of cards here. So obviously this one is out. Remember, in the examination, you just have to know, hey man, this one is just an odd one out. You just have to ignore it and cancel it right away and move on. Concentrate much of your energy on potential answers. Now, when you talk of test data, let us use substitution, elimination, Test data is when we use the dummy data to test a transaction or a control. So obviously, test data is out. Remember, this guy is analyzing trade receivable balances which are over 90 days using an audit program. So we are using an audit program. All right. So obviously, yes, there is some aspect of testing. But what we are doing there, we are using a technique called audit software. We are just using audit software to do that. All right. We are not using test data. We are not inputting anything. There's nothing that is being inputted. All right. We are not inputting anything. So in that case, we are using all the software or application controls. Remember here, even from the verb here, the auditor is using computer program to read, right? So is he making use of application controls? To some extent, you're going to say, oh, yeah, he's using application controls, but that's not what application controls are meant to do. All right? Let us hear from the examiner to see what he wrote about that. The answer is audit software. Audit software or audit programs are used to interrogate and analyze a client's actual data files to select samples, identify exceptions, or reperform calculations. Let us now listen to the incorrect answers to see what the explanation said. A. Application controls. Application controls are procedures within the client's IT system. This question describes a procedure performed by the auditor using their own tools. So this is why I say, in as much as application controls could be, linked to this aspect, the fact is that application controls are the procedures from the client side on the ICT system of the client. And are done by the client, although tested by the auditor. But when the auditor is testing the application controls, he is using audit software. Are we together? So the receivable balances and so forth are are products of application controls. But when we are now using a computer program to test those applications, we are now using audit software. Is that clear? Good. B, test data. Test data involves inputting. Like I said, there was no inputting of anything here. So test data involves inputting dummy transactions into the client system to check its processing logic, not interrogating existing client data files. We were just interrogating, analyzing only the receivables which were above 90 days. Nothing was being input in the system. So in that case, the test data fell out. D, an ICQ, internal control questionnaire or evaluation questionnaire. An ICQ is a tool used to document and evaluate the design of internal controls, not a technique for electronically examine data. So this is why we cancelled out that one outright at first instance. Question 4. Which of the following is an inherent limitation? The word inherent, you now know it, isn't it? Just due to the nature of it. Okay, so this one is just due to the nature of the transaction or system. It is actually something that is going to be a limitation due to the circumstances surrounding the case. So which of the following is an inherent limitation of internal controls? That means an auditor must always perform some substantive testing. So the question is saying, which of the following is an inherent limitation? Is an always resident limitation, despite whatever those internal controls are going to be, reinforced and so forth. That inherent limitation is going to be there. All right, that's what the question is asking. All right. Actually, this one is what is called a permanent problem. An inherent limitation is considered a permanent problem. No matter how beefing up or how strong the controls could be, supported, they are going to be having this particular problem. And the auditor should then be always aware that substantive testing is necessary. So from the solutions, you are supposed to pick those. Yeah, you need to pick those or that option that speaks of the inherent problem, of the permanent problem. A, the lack of an internal audit function. Is this going to make auditors think of doing substantive tests because the entity doesn't have an internal audit function? That one is a no. Okay. The fact that we do not have an internal audit function doesn't mean that our internal controls are having an inherent weakness. No. The cost of implementing controls is greater than the potential benefit. To some extent, I think this one could be. Yeah, this one could be, but we need to look for the best. All right. Yes, because it is a very, very important factor to consider, because when implementing controls is not going to give us more benefits than the cost, then we should be worried, isn't it? So let me just put a question mark there. Because in the exam, at least there are certain options you just need to mark as this one could potential, Okay, let me try to. Yeah, I don't know what's happening with my machine. Seems like it's overheating, and my image is not coming out nicely. Okay, The potential for human error or collision. Hmm? This one again seems to catch my eye. So I also have to put a question mark. That's why I'm putting these question marks that these options are giving me some headache, right? Let me proceed. D, the system being recorded using narrative notes instead of flowcharts. Automatically, this one is out. Okay, the fact that the system is being recorded or using narrative notes instead of flowcharts doesn't mean that automatically the auditors would then have to do substantive testing. All right, sometimes narrative notes are essential, sometimes they are not. And the fact that we are using or the system was being recorded using narrative notes doesn't make it a vulnerable system, isn't it? Good. So A and D are out. So let us now then revisit B and C. Okay. These things, the revisiting and proceeding are done in a second, in a split of a second, right? During the examination, there won't be such time. So you need to be moving. You need to be on the run. So B was saying, the question is saying, which of the following limitations are automatically going to cause auditors to do substantive tests? All right. So B, the cost of implementing controls is greater than the potential benefit. Well, like I said, sometimes implementing controls could be much expensive and so forth, which does not warrant, implementing them. Okay, or this might cause entities not to implement certain controls because of the associated cost. But now, that assertion or that view is not going to be the motivator for auditors. All right, in as much as auditors would be skeptical about our internal controls, or would be having this skeptical mindset that certain controls are not going to be implemented because of higher cost. That on its own is not going to motivate auditors to do substantive tests. All right, it's too speculative, it's too far. All right, uh, like I said, it could be picked if C was not there. If C was not there, then we could at least suspect that B could be the reason why auditors should always do substantive tests. All right. It's a good view from the skeptical mindset that because auditors, when they approach the company or the client, they need to not trust things at face value. They need to have this mind that you know what, certain controls are not going to be implemented by businesses because of certain costs. So we need to be careful. We need to check ABC. Those are risk problems because having a qualified credit manager is normally going to be very expensive for small companies. So they tend to just use the same person. The accountant is going to record the books, is going to be the credit manager, is going to be all those things. All right. Because for them to hire a qualified, experienced credit controller is gonna be, very expensive to them. But that doesn't mean that they should then do substantive tests whenever they reach clients. No. But when we look at C is more rich because it is telling us that there is a possibility, even if the internal controls are strong, we have got credit managers, we have got, the financial accountants, the management accountants are in place, and the finance team is well beefed up, well resourced, and everything. But despite of us having all those things in place, there is a potential for human error or collision. So this is why we need to do substantive testing. So you see, this is why C is the most appropriate. I'm sorry. I'm sorry. I am taking much of your time. I know you want the drama. You want to just do this thing. You want it for all and move on with your lives. But these are certain pitfalls which usually make students getting stuck around 46%, 48% in each and every AA exam because the answers are almost like the same, but they are very, very different. Let's move on. There was the explanation by the examiner. You can pause the video and read it on yourself. Question 5. In a computerized environment, controls that relate to system access, program development, and data backups are categorized as what? Okay, we are in a computerized environment, all right, and we are now required to categorize, okay, the controls which relate to system access, program development, and data backups. A, output controls. B, general IT controls. C, application controls. D, segregation of duties controls. Obviously, by elimination, you can tick out that one, all right, and then crack your head to see which ones of the three left is which one is the correct one. Okay, let us deliberate on this. Let's start with A. A talks of output controls. Output controls, these ones are controls that ensures that results of the system are accurate, complete, etc. Okay? But they are controls related to applications. So they are part of application controls. And when we talk of application controls, these ones are specific uh, specific IT controls to certain applications or functions. Right? Remember, we learned that they are part of the client's IT system and so forth, but they are related to specific functions. For example, e.g., sales, payroll, financial accounting, etc. All right, they are for specific applications. All right, at least that's what we are talking about. But now, all these, I mean, both these are are embedded or are constructed from the general IT system or IT control environment. So they are actually going to be constructed or to emanate from general IT controls. So the general IT controls are like a framework, or can I say the conceptual framework? So the framework on which these applications are going to operate from. All right. So the question here, the best answer should be B. All right. These are the controls that relate to system access. For you to be able to have an application, you need to first of all have access to the IT system. All right. So you need the general IT control access. All right. The access to the framework. Right. So you need the general IT controls to have the access to develop a program. You are going to develop it from the general IT control access. You can only do backups on the general IT control system. All right. Good. Let us hear from the examiner. General IT controls provide the foundational framework for the overall IT environment and support the effective functioning of many different applications. So this is why general IT controls are the answer. Incorrect answers include A. Output controls. Output controls are a specific type of application control focused on ensuring the results of processing are accurate, complete, and properly distributed. C. Application controls. Application controls are specific to individual business processes like sales or payroll, focusing on the processing of transactions. D. Segregation of duties controls. While segregation of duties is a key concept within IT, general IT controls is the broader category for controls over the entire IT infrastructure. Okay, well, like I said, segregation of duties was a way out, but to some extent, it wasn't really going to be easily excluded by students. Why? Because if we are given a series of, responsibilities like controls related to system access, program development, data backups. Somebody might think and say, "Oh, so those are the processes which are different, which have got a different dimension from one another." So obviously, segregation of duties is necessary. Well, that was going to be, a wrong answer, my brothers and sisters. All right, the correct answer was general IT controls, and I hope the explanation has sunk well. Let us move on. When recording a client's accounting system, which method imposes the most discipline and is particularly effective at showing where checks are performed? So this one now is testing your recording of internal control systems, the aspect of those narrative notes, flow charts, and so forth. So you are being asked which method can present or can show where checks are performed. Okay. The question is requiring us to determine the best way of recording a client's internal control system. And obviously, this one is done at the start of the audit, not at the end. So, management letters, these ones are just a final product. This one is, like I said, it's a corporate social responsibility item. Auditors normally produce these RTMs just as part of uh, value adding to their audit, where they explain the ineffective controls they encountered during the audit, with the hope that management are going to implement them as part of reinforcing their internal controls. All right, but in as much as they would discuss the weaknesses of the internal control system, they are not part of the recording of the client system at the start of the year, and they do not show where exactly. It is just a report. It will be in narrative form. Okay, so the hint was that of recording a client's accounting system. Recording is done at the start of the audit work, so automatically management letters are out. Is that clear? Good. Internal control questionnaires, ICQs are effective in our understanding of the internal control effective environment of the company, to see if it's like a checklist. Okay, it is a checklist. It shows if certain controls are in place and so forth. So in that case, they are effective, but not in a way or in the sense of presenting where exactly the checks are performed. They are not going to show us. Okay? They might tell us that checks are being performed, but where exactly, they do not show. Because they are standardized. Normally they are just standardized. Do you have this? Do you have that? Do you have that? Do you have that? Are you doing this? Are you doing that? They can tell us that one, but where exactly, they are not going to show us. So in that case, they have got a limited. They are not our answer. What about flowcharts? Flowcharts, these ones are specific diagrams. They're going to be drawn and so forth, and they show what will be happening, where checks are performed and so forth. So these ones, they have got that presentation capability. So they can be our answer. Yes, they show, because they are diagrams and so forth. So they show us where the checks are performed. Narrative notes, yes, narrative notes can detail, like they're just like management letters. They detail, all right, they detail the process of the transaction and so forth. They are wordy and this and that, but because they're just words and text, they're not going to show us where the checks are going to be performed. Yes, you need to read and read and read so that you would then understand, where the checks are. So in as much as you will get the information, they themselves do not show you. The aspect here is on showing. Effective at showing. Remember, effective at showing. That was the requirement. Effective at showing where checks are performed. So the answer should be C. Yes, let us see what the examiner said. So the answer is flowcharts. Flowcharting uses standardized symbols and rules to diagram the flow of documents and information, making it a highly structured method that can clearly highlight control points. All right, so you can see that there is more visualization in flowcharting. Now, the incorrect answers included A, management letters. A management letter is a communication from the auditor to the client about control weaknesses. It is not a method for initially recording the system. Remember, we record the system as part of our understanding of the client's business systems and control environment. So during the management letter, that will be the final product, one of the final products of an audit. So we won't be initially recording the client's controls. B, internal control questionnaires. ICQs are useful for evaluating controls against a checklist of questions, but do not visually represent the flow of transactions and documents. So that's why it was also an incorrect answer. Narrative notes. Narrative notes can lack structure, making it easy to miss steps or the final disposition of documents. Are we together, ladies and gentlemen? Great. Question 7. Key control objective for a commercial system is to ensure that goods are only dispatched to credit-worthy customers. Which control activity would best achieve this objective? So the objective is to ensure that goods are only dispatched to credit-worthy customers. That's the objective. So which control activity? The control activity is the procedure we are going to do to ensure that the goods are only going to be dispatched to credit-worthy customers. A, matching dispatch note to sales invoices to ensure all dispatches are billed. While this one is actually a good control practice, it is only going to help detection, but not prevention. Because remember, the objective there is to prevent goods from being dispatched to non-credit-worthy customers. So that one is about detection, so it is wrong. B, regularly reviewing an aged receivables ledger to identify overdue accounts This one again speaks of detection or accuracy, whatever. C, performing a credit check and setting a credit limit before a new customer's first order is accepted. I put a question mark. This could be the correct answer. Let me read D. Sequentially numbering all dispatch notes to ensure none are missing. This one again has something to do with some detection, right? Okay. It is not speaking about us limiting our exposure to non-credit worth customers. So this one is not. So automatically we are left with C. But let us see, because if we set some, so if we do some credit check and set some credit limit, obviously we have met the aspect of credit with customers and so forth. So if we do that during the customer's first order, before accepting the customer's first order, then we are good to go. We will ensure we will be at least reasonably assured that we are sending goods to appropriate customers. Let us see what the examiner, if the examiner is agreeing with us that the answer is C. Yes, the answer is C. The explanation is that this preventive control directly addresses the risk of making sales to customers who may not be able to pay by assessing their creditworthiness upfront. So we need to do some credit check and set a credit limit before a new customer's first order is accepted. Wrong answers. A. Matching dispatch notes to sales invoices to ensure all dispatches are billed. This control addresses the completeness and accuracy of billing, but does not prevent sales to customers who may be unable to pay. So this is why I said it was related to detection controls, right? So it enables completeness and accuracy of our billing. B, regularly reviewing an aged receivables ledger to identify overdue accounts. This is a detective control for managing existing debt, whereas the objective is to prevent the sales from happening in the first place. Well, examiners are so serious. D, sequentially numbering all dispatch notes to ensure none are missing. This control ensures that all dispatches are accounted for, which is important for completeness of recording, but it doesn't relate to the customer's ability to pay. So this is why it was also wrong, but you have had extra information about these controls, which is a plus for the purpose of our knowledge. Let us move on. What is the primary purpose of standing data controls, such as periodically reviewing employee pay rates or product price lists? All right. Standing data, we know standing data, that data that is not frequently changed. Okay. The product price lists, employee pay rates, they normally do not change overnight. So they are meant to be like that for a long period of time. All right, so what is the primary purpose of standing data controls? So controls on that data. What is the primary purpose? A, to check that the results of batch processing agree with the input total. Okay, this, in as much as batch processing is assisted with standing data controls. Could that be the main purpose of the controls? To check that the results of batch processing agree with the input total. We're gonna put a question mark, but we are not quite happy. B, to prevent unauthorized users from gaining access to the accounting system. Standing data doesn't mean standing guard or standing, or guards on duty, something like that. No, it has nothing to do with access. Access controls or physically guarding the data. No, that one is has nothing to do with unauthorized access to the accounting system. All right. Okay. To ensure that all transactions that occurred are recorded in the system. To ensure that all transactions that occurred are recorded in the system. Standing data doesn't, standing data controls do not, like I said, they do not change uh, over a period of time. So um, they can't be used to confirm accuracy. All right. Because C is saying to ensure that all transactions that occurred are recorded. They don't give us any information about the completeness of the recording. So this one is wrong. D, to verify the accuracy of data that is used um, repeatedly and can affect many transactions if incorrect. Yes. You see, this data, for example, the employee pay rates or the product price lists, they are standing data in the sense that they do not normally change overnight. All the time. So when we then input data, we need to verify if the data we input was actually correct. We will be referencing to the standing data. If it is about prices, we'll be referencing to the standing data. So the price, let's say for a pack of sugar, a 2 kg pack could be $2.50. All right. So when a sale has been made, we then have to verify with the standing data, the standing price of 250 to see if the actual sale was 250. So this data could be used to verify the accuracy of the data. All right. And they are essential because they do not change over time. So they are essential in verifying repeated transactions. All right. They can be used to verify repeated transactions. So I think the answer is D. Let us see what the examiner said. The answer is D. All right. Do not know what's happening with my. Maybe it's now dark. Let me try to put the lights on. I hope you could see me. Or I'm still as dark as. All right. Let me try to change directions. Direction. Okay. Um, the explanation then. Training data does not change often, but is referenced frequently. So an error in it, like a wrong price, can be replicated across numerous transactions, making its accuracy critical. So here the examiner is simply saying that this stating data should be correct, because if it is incorrect, a lot of transactions which are linked to that, for example, a sales price, if the sales price of the standing data in the system, that's why when you enter the shop, they say, let us check the price in the system. That will be the standing data. right? So if the price is wrong, it means a lot of transactions are going to be wrong, are going to be affected. But it is data that is referenced very, frequently. Yeah, by a lot of transactions. So that's standing data for you. The incorrect answers A, to check that the results of batch processing agree with the input total. This describes a processing control, such as a control total or run-to-run control, not a control over reference data. B, to prevent unauthorized users from gaining access to the accounting system. This is the purpose of process controls, okay, which are a type of general IT control, not a control over a specific reference data. All right. C, to ensure that all transactions that occurred are recorded in the system. This describes a control objective related to completeness of transaction processing, not the accuracy of reference data. So our answer, ladies and gentlemen, was A, to verify, was D, to verify the accuracy of data that is used repeatedly and can affect many transactions if incorrect. Question 9. The risk that financial statements include accounting estimates which involve judgment is an example of what? The risk that financial statements include accounting estimates which involve judgment is an example of what? A deficiency in the client's control environment. Is that a deficiency? No, that's not. That's not a deficiency. All right. Because accounting standards encourage accountants, okay, to make estimates or require them to make estimates. So that's not, we can't say that one is an example of a deficiency in the control environment. B, an inherent limitation of an audit which prevents absolute assurance. We can put that one a question mark. Yeah, we can put a question mark on that one. C, a business risk that is not relevant to the audit of financial statements. Is that a business risk? When we put when we have estimates in financial statements, is that a business risk? That one is not a business risk. Okay. Remember, a business risk is that risk that affects the operations and the financial performance of the company. All right. So that's not, a business risk if we have estimates in our financial statements. All right. Also, if we consider it a business risk, having estimates can't normally cause some, business disruptions to our business processes. Just because we have got estimates in the financial statements that cannot really affect the business processes and so forth, and that it doesn't make sense at all. Yeah, it doesn't make sense. But we can then say we can't as well say just because it does not affect the business processes, so therefore we just have to ignore it in the audit sense. No, we cannot ignore estimates as auditors. All right, we just have to, we are required to evaluate the reasonableness of those judgments. So it is a risk that is relevant to the audit of financial statements, and we need to consider it. So C, although it is complex in its lack of reasonableness, it is a wrong answer. Well, it from the way it was worded, it's something that tended to confuse and so forth. But in that confusion, some people might be hoodwinked and end up choosing it. But what we are simply saying is that at first instance, it is not a business risk. In the audit sense, because business risk is, is that risk that affects or that stops the entity from attaining its business objectives. So, estimates in financial statements do not really have a direct bearing on the entity's performance, whether in processes or financially. That one is not gonna, happen. It's not gonna result. All right. And we also touched the angle that even if it was some business risk, uh, we can't ignore, as auditors, we can't ignore those estimates. We can't ignore them because they are part of the audit work. Remember, accounting standards require management to make those judgments they were appropriate. So as auditors, we are required to evaluate the reasonableness of those judgments. So we can't ignore them. So this is why I say C is incorrect. D, a failure of the audit assembly technique leading to assembling risk. Remember, we are looking at the risk that financial statements include accounting estimates. Can that be said a failure of the audit assembling technique? This one again is wrong. So, because financial statements contain some judgment, some estimates which are made by management, they impose an inherent limitation of an audit which prevents absolute assurance at what? But reasonable. So we are only going to give reasonable assurance, not absolute. All right? We can't really be sure. We can't really come up with a very objective and accurate figure because there have been some estimates. Our estimates, for example, on the useful life of an asset could be wrong. And this is why we then have to use reasonable assurance. To give you reasonable, not absolute assurance. All right. That is from me. Let us see what the examiner said. B, an inherent limitation of an audit which prevents absolute assurance. So we were right. Explanation. Because financial reporting requires subjective estimates, an audit cannot provide absolute certainty, only reasonable assurance. This is a fundamental limitation of the audit process. The wrong answers. A, a deficiency in the client's control environment. While a poor control environment could lead to unreasonable estimates, the need for estimates itself is a feature of financial reporting, not necessarily a control weakness. That's the the examiners. All right, their English is well elaborated and articulate, and you can match. All right, you can match. See, a business risk that is not relevant to the audit of financial statements. The subjectivity of estimates directly impacts the financial statements and is a key source of the risk of material mistake, making it highly relevant to the audit. D, a failure of the audit assembling technique leading to assembling risk. Assembling risk arises from testing less than 100% of the population, whereas the use of estimates is a fundamental aspect of financial reporting itself. Right? Take it or leave it, guys. Question 10. Which of the 5 components of internal control relates to the tone at the top and the ethical values and culture of an organization? Guys, we need to be very, very conversant with the COSO framework. Okay? Because that's where all these are emanating from. All right? And in the notes, they were clearly elaborated. In the audio which we sent you, they were clearly explained. So I do not expect you guys to falter. So which of these components And I also want you guys to tell me the missing component here. There is a missing one. There are 5. All right. So I want you to tell me in the comment section to the video the missing component. All right. Tell me the missing component. So which of the 5 components of the internal control relates to the tone at the top? A. Monitoring of controls. The monitoring of controls. Can this tell us about the tone at the top? This one dot. The control environment. Control environment. Yes, control environment. This one is the answer. Because control environment, we're talking of the control culture. Yeah, the culture. Management. Supporting the aspect of integrity, the aspect of effective controls. So the control culture, the corporate citizenry of management, all those things, are they up to the billing when it comes to internal controls, when it comes to risk management? What is their attitude towards risk and so forth? So the control environment. And then the risk assessment process, no. Control activities, these are the actual procedures which are done in designing and implementing the internal control. So in that case, we're not talking of the tone at the top. The tone at the top is found in the control environment. Let us see what the examiner said. Yes, B, the control environment. Explanation: the control environment encompasses management's attitude, awareness, and actions concerning internal controls, effectively setting the overall tone for the organization. Incorrect answers: A. Monitoring of controls. Monitoring is the process of assessing the performance of internal control over time rather than the foundational culture and ethics of the organization. C. The risk assessment process. The risk assessment process is how management identifies and responds to business risks, not the overall ethical culture of the entity. D. Control activities. Control activities are the specific policies and procedures, for example, authorization, reconciliations, that help ensure management directives are carried out. So the best answer was B. Last but not least, there's one more. So question 11, an auditor notices that the same person who authorizes purchase orders also has the ability to record the receipt of goods. This situation primarily represents a weakness in which control activity? Authorization? No. If one person is doing the same thing, that is a control activity not related to authorization, because the person could be having the powers to do that. All right. So the control activity that could be lacking, this one is just a takeaway. So just a bonus thing. That's segregation of duties. Let's see what the examiner said. Yes, segregation of duties. This control principle aims to prevent fraud and error by ensuring that no single individual has control over all aspects of a transaction, such as authorization and custody of assets. So incorrect answers: A. Physical control. Physical controls relate to the safeguarding of assets like inventory, not the assigning of duties within the account system. Remember, the question was also talking of the accounting system where we have the authorization of purchase orders and the receipt of goods. This is talking of the accounting system for procurement. Okay. Authorization. While authorization is part of the process, the core weakness here is the lack of separation between different key functions. So the answer is C, segregation of duties. Last but not least, this was the last question, ladies and gentlemen. When an auditor discovers a significant deficiency in internal control, to whom should this finding be formally communicated in writing? All right. Remember, guys, when we are talking of the auditor, we are talking of the external audit. Remember, this paper is for external auditing, not internal auditing. So a lot of students who are in internal audit, they tend to confuse themselves. Some say, oh, there was no answer because we report to the CEO and so forth. And some say, oh, we report both to the CEO and the audit committee. And oh my God. Guys, this is external auditing. It's a paper for external auditing. So when you find a deficiency, remember we talked of the management letter or the RTM, the report to management. That's when you report those things, those deficiencies, significant deficiencies in the internal control. The aspect of the word significant, significant is related to materiality. All right. Remember, we use materiality in our auditing. So, these are significant controls you want to highlight. You want management to put attention on. So, the question is saying, to whom do you report those findings? A, the lawyers. Do you report to the lawyers? No. The junior audit staff responsible for that area of the audit. Do you report to your junior on those things? Obviously, it is the juniors who would have brought those things to your attention. Remember all those things, right? Or maybe you happen to be part of the team, but would that make sense if you report to your junior and say, hey man, we found these deficiencies. Let us take our cup of beer. Is that going to solve anything? Obviously, that one is a complete cancer. C, the specific department manager where the weakness was found. Well, this could be, could be necessary when the issue is not significant. But when it is now significant, obviously you need to report somewhere else, not the specific department manager. D, those charged with governance. Yes, the TCWG. Those charged with governance, such as the board of directors or the audit committee. That's the best term for you to pass this examination. Please don't forget using that term, TCWG. Yeah, that phrase. That's their name. Those charged with governance. They are beyond the CEO. They are beyond an individual manager. We are talking of the board of directors or the audit committee. Is that clear? Great. Let us see what the examiner said. The correct answer was D, those charged with governance, such as the board of directors or the audit committee. Explanation: a significant deficiency is defined as being of sufficient importance to merit the attention of those responsible for overseeing the end strategic direction and obligation. Wrong answers. A, the company's external legal counsel. Legal counsel is typically involved in legal matters. Not the routine reporting of internal control deficiencies. So spare the lawyers the trouble, please. B, the junior audit staff responsible for that area of the audit. While junior staff may identify the issue, formal communication of significant deficiencies must go to a higher level of authority. C, the specific department manager where the weakness was found. Other less significant deficiencies may be communicated to department management, but significant ones require the attention of those with overall responsibility for the company. Are we together? So that is why we say the correct answer was those charged with governance, such as the board of directors or the audit committee. Yes, guys, I hope you are doing fine. Like I said, my name is Mr. J. Motimokulu. If you want more coaching, that is my number on the screen. It's compliant for both direct calls or WhatsApp. All right. Until next time, guys, please continue to feel excited.